With the tax year end fast approaching, we sat down with our client directors to get the answers to the most frequently asked tax year end questions.
Officially, the date for the end of the tax year each year is the 5th of April. The period from the prior 6th of April to the 5th of April is when you need to consider a number of items, such as how much income you've taken so far, if you want or need to take any more and the tax implications of doing so, making sure you've utilised any allowances that you wish to make use of, and thinking about the future tax years. Do you need to make any changes to how you take income? Are there any upcoming advantages or disadvantages with changes in tax rates, allowances, or generally a change in your circumstances? As we approach the end of the tax year, it's a good time to get your ducks in a row. The most asked question is always, can I take any more dividends? The answer is normally yes, providing the company has enough profit to do so. But key elements from this question are, firstly, is it tax efficient to take any further dividends? And if so, what will be the tax implications of taking more? When considering if there's enough funds to take any further dividends, you always need to be aware that corporation tax is payable first on the profits of the company. Any remaining profit after tax and profit carried forward is what is available to the shareholders to pay out as dividends.
So in the current tax year, there are three main dividend rates that you should be thinking about. It is the basic rate, the higher rate, and the additional rate. You also have a £500 tax-free dividend that you can use each year. So if you haven't taken that so far, do so. In the basic rate of tax for dividends, you will be paying 8.75%. At the higher rate of tax, you'll be paying 33.75%. And at the additional rate, you'll be paying 39.35%. It is worth noting that from next tax year, there will be a 2% increase in tax at both the basic and higher rate tax, so be aware of that. If you are an individual who has used up all of their personal allowance through means like a salary or rental income or interest income, for example, and you've utilised your entire basic rate up through dividends, you can reasonably expect to receive a tax liability of around £3,255. One of the biggest things that people will fall down on is payment on accounts. This is a process where you will make a contribution towards next year's liability based on the current year's liability. Now, in most cases, this isn't too big an issue because you should be continuously setting aside small provisions for your tax as you go along. So provided you've been doing that, you will have that in the time that the payment is due. What we'll be doing when your tax year ends is we'll be providing a questionnaire to all of our clients to gather the information that we need from them to prepare their self-assessment tax return. If you want to get on top of your liability soon, the sooner you give us the information, the sooner we can complete that and start having conversations with you about how to deal with it. So when it comes to expenditure, your year end and your tax year end can often differ. So if you do have a tax year end and a company year end that are the same, the biggest expense you should be thinking about really is your trivial benefits. That goes for companies as well that do not have coterminous year ends, but it's less of a pressing matter for you. Your allowance for trivial benefits is £300 a year, and that is tax year. So as a director, you have certain limits applied to you. It's £300 per tax year and no larger than £50 per benefit. The biggest thing that you should be thinking about with your expenses is keeping hold of your receipts. It is a statutory requirement for you to keep hold of these for up to 6 years, and HMRC can apply penalties of up to £3,000 should you fail to do so.
If you're looking to maximise your savings for the year, the current ISA allowance this year is £20,000. Any interest from these savings are exempt and will not be taxed. The same allowance applies for your spouse, and for the junior ISA, this is £9,000. It's important to remember that any contributions into an ISA must be made from personal funds, and if you don't utilise the full allowance, any unused allowance is not carried forward for you to use in the future. There are two ways in which you can contribute into your pension pot. As an individual, you can make an employee pension contribution, or you can make employer contributions directly from your limited company, which can give you greater flexibility on the amount you wish to contribute. Personal contributions will mean that you'll get tax relief through your self-assessment tax return. This can help with reducing your overall taxable income for the year. whereas by making employer contributions through the limited company, it's treated the same way as any other business expense, therefore reducing your corporation tax liability. There is also opportunities available for your spouse and other employees too. The maximum contributions that you make into your pot, both employee and employer together, need to remain below the annual allowance, which is currently £60,000. But if you have not maximised your pension contributions in the prior 3 tax years, there is a possibility of using the carried forward allowances, which means you can put up to £220,000 into your pension pot. Before doing so, it's best to double check any allowances and discuss your contributions with a financial advisor.
You can also reduce your company's liability by diverting your company's pre-tax profits into a company pension. Any contributions must be made before your company's financial year end to qualify for the deduction. By investing personally into an enterprise investment scheme, venture capital trust, or seed enterprise investment scheme, you would receive tax relief at 30%. If you receive child benefit and have a net adjusted income of between £60,000 and £80,000, the amount you have to repay is tapered. Once you reach a net adjusted income of over £80,000, the full amount is repayable through the higher earner's self-assessment tax return. An income of over £100,000 will start to reduce your personal allowance by £1 for every £2 over you go. You could consider personal pension contributions to reduce your net adjusted pay. If you are a basic rate taxpayer and your spouse is not using up their full personal allowance, you can use the marriage allowance. So, if there's one message to take away from all of this, it's that the tax year end isn't just about ticking boxes. It's about understanding where you are now and making informed decisions before the year closes. If you're unsure about what action you should be taking or whether there's anything you can do before the 5th of April, it's always worth getting advice sooner rather than later, because once the tax year ends, the opportunity is gone. Thanks for joining us, and hopefully that's helped make the tax year end feel a little less daunting and a bit more manageable.